Hello. Hello friends. Welcome to Professor Reena Lenka's channel. Today I would be discussing on a topic regarding the Companies Act 2013. Now before we start, let us understand what a company is all about. A company can be defined as an artificial person, invisible, intangible, created under law with a discrete legal entity, perpetual succession and a common seal. Now artificial person means that the person would be having its identity and it would be having all the privileges as an Indian citizen. It is invisible because it is not having a human body, and it is intangible means you cannot touch it but you can feel it. And it is created under the law because it is having the legal backing. Anything goes wrong with the company can sue that person. Now let us go to the striking characteristics of a company. The most striking characteristics of a company are it is having a legal identity. It would be having a common seal. Now legal identity I have already explained to you. Common seal means it would be having a kind of a sign. For example, if you take an example of say BMW. Now if a car having that mark, you can from a distance you can make out that it's a BMW. For instance, if you take Tata Group, in that also it is having a common seal or a sign through which you can understand that this is a company. Then it is also having a limited liability. Now what do you mean by limited liability? Limited liability means that the shareholders or the stakeholders of the company, they would be only sharing a part of the money which they have already promised. Now, when a company is in trouble, the shareholders would be only going for that much money. For example, if the company is in debt of say 50 lakhs of rupees and the shareholders have already promised that they would be only sharing 1 lakh rupees each. Now suppose there are 10 shareholders, means they would be only sharing 10 lakhs rupees. So the rest 40 lakhs of rupees would be given by the company itself. It cannot take any help from the shareholders. Then comes perpetual succession. Perpetual succession. What do you mean by perpetual succession? Perpetual succession means when a company is started, it will continue till the person or the owner of the company feels like ending or winding up the company. So once the name is there, it would be there for ages together. Now the company has a separate property. Now, what is the meaning of a separate property? Means the company, the setup of the company, the place where the company has been set up, that property does not belong to any member of the company. It would be the whole and sole property of the company. So any problem happens during any kind of liability, then the company has got the right to sell off that property. No one can take benefit of that property and can use it for personal use. Then we have transferability of shares. The transferability of shares means a shareholder can transfer a part of its share to some other person. So the other person also becomes a part of the owner of that company or becomes a shareholder. Capacity to sue and be sued means when something goes wrong with the company, if someone has done something wrong, for example, has borrowed money from the company and is not ready to pay the money, or has gone for certain kind of legal case against the company, then the company has got every right as an individual to sue that particular person who has done something wrong towards the company. So, friends, I hope you are understanding what I'm trying to say. Now, let us go to History of Companies Act in India. The Indian company law began with the Companies Act 1850. Actually, it started from the British period, and the Britishers started with this Companies Act, and it started in 1844. Now then, the Indian Companies Act came in 1913, and it was based on the Companies Act, British Companies Act of 1908 things. Then the Indian Companies Act fully started from 1956, and the date was 1st April. And then there was an amendment of the Companies Act in 2013. Why it was amended was because in 1956 there was certain clauses in the company which was not good enough to take care of entire company related problem in India, because India was becoming multinational. At the same time, certain clauses which was already there in Companies Act 1956 wasn't good enough to overcome this problem. So the government thought of providing and amending all those clauses which was absent in 1956 in Companies Act 2013, so that India can take care of the matters much better. Now, friends, let us come to the highlights of the Companies Act 2013. Now, this was passed by Lok Sabha. So, friends, you must be knowing Lok Sabha and Rajya Sabha. Lok Sabha is the highest authority which passes all these things, right? So, it was passed in December 18, 2012, and again it was passed in Rajya Sabha, because both the Sabha has to pass all this amendment and then only it becomes legal. So then it was passed in Rajya Sabha in August 8, 2013. Now the total number of sections in the Companies Act was 470. Total number of chapters in the Companies Act 2013 is 29. Total number of schedules added is 7. And it was effective from September 12, 2013. And the name of the committee which came with this Amendment Act of 2013 was J.J. Irani Committee. So friends, let us come to a comparison between 1956 and 2013. There is a structural comparison in Companies Act 1956 and the Companies Act 2013. In Companies Act 1956, we have 13 parts. In Companies Act 2013, we have 29 chapters. Companies Act 1956 has 658 sections. In Companies Act 2013, we have 470 sections. Companies Act 1956 consists of 15 schedules, and Companies Act 2013 has only 7 schedules. Now, basically, the objectives of Companies Act 2013 is to promote the development of the economy. Now, what do we mean by promote the development of the economy? Now, what has happened is, after 1956, Indian company has started becoming multinational. So what happens is the economy of the company has started increasing also. So in order to cope up with the increasing economy requirement, there is a need for a Companies Act where the development of the economy is taken place. Because if you know, all of us know that economy, major part of the economy is being done or is helped by the company, the corporates, whoever is there throughout India or throughout world. So the company plays a major role in the economy of the country or the financial aspect of the company. So the act is basically to promote the development of the economy, means how better a company can develop its economy and also can do justice to the economy of the world, to India. Okay, to encourage transparency and accountability. Now, in company, there are so many people who are taking on the responsibility. Like there are so many departments also, like if you see, marketing department is there, finance department is there, IT sectors are there. Then at the same time, we have shareholders of the company, we have directors of the company, we have the all the stakeholders. The stakeholders means those people who are connected with the company, means those people who are attached to the company, the lenders. Then we have the auditors. Then we have the customers. So when a company is working, the company is for the people also. It should be doing benefit for the people. Now, anything which is happening within the company, between members, between the shareholders, or between others, people who given money to the company has got the share. They also have the right to know what exactly is happening in the company. So there should be a transparency of any ideas or any policies which is happening from the higher level to the lower level, and whoever is doing all this, making the policies, should be accountable for the same. So in order to encourage transparency and accountability between the members and the stakeholders, the Companies Act has decided to go for this. Then to promote high standards of corporate governance. So what do you mean by high standards of corporate governance? And the corporate governance means the company, how best it can take care of the company's effort. Okay. So in order to maximize the standardization of the company, now that the company is doing good, the company's product is good, and the policies and everything has been taken care of properly, then what happens is the shareholders, they are ready to invest money in such a company where the governance is being made and where there is a transparency. So the high standard things, whichever is happening in the company, is good enough for the company so that the shareholders are ready to invest and the company can grow. Then we have to recognize new concepts and procedures to support business while protecting interest of all the stakeholders. Now we can come with so many concepts, so many procedures for the business, but if the stakeholders are not being benefited, stakeholders means the shareholders and the customers, if by the policy of the company, if these people are not benefited, then what's the use of company coming out with all these policies? So in order to have business, to support the business, the interest of the stakeholders has to be taken care of. So the concepts and procedure, whatever the company is taking, should be keeping in mind the stakeholders and the interest of the company. And also another thing is very important, if there are any fraud which is going on in the company, the provisions in the Companies Act 2013 has been made that the company can take action against the fraud doers. So friends, let's go to the new concepts which are introduced in the Companies Act 2013. I hope you people are enjoying my lecture. So let's continue. So the company has come out with different types of companies. One company which has been introduced in the Companies Act 2013 is a one-person company. Now a one-person company means it's basically a term for a sole proprietorship. Means you are the whole and sole owner of a company. A person, only a single person is the whole and sole owner of the company and can carry on with the business. So this has been made to give relief to the proprietor, because previously it has to be a proprietorship form, but now it has become a company. So this is again a beneficial thing for a person, a single person who is starting with a company. That person can have a one-person company, and it would be only having a single person, and he or she can be a single director and also can have one shareholder. So this is the meaning of one-person company, where all the rules and regulations, all the policies, everything is being taken care by the one-person company. And in this, there is no need of an annual general meeting. There is no need of, giving out share to any other people. Nothing is required. So it's a one-person company or a proprietorship company. Then we come with another new term known as a associate company. Friends, you must have been knowing regarding a subsidiary and a joint venture company. But this is not a subsidiary or a joint venture company. Associate company means when two companies comes together and one company has got an upper hand on the other company. Means it is influencing the company in a much better way. Means it is controlling, it is at least having a control of 20% of the total share capital, and also taking part in the business decisions and agreement. So friends, don't get confused regarding a subsidiary and a joint venture company. Here, associate company means two companies where one company is having an upper hand and controlling 20% share of the 20% of the total share capital, and also is taking part in the business decision and then under an agreement. Okay, so now let us go to a dormant company. You must have heard about this term. What is a dormant company? It is under section 455. So here dormant company means which is already formed and it is registered, and this would be registered under the new law, under the Companies Act 2013, and this is for some future project which till now the project hasn't been made, but the project would be taken care in a future date. For example, today if I am having a FMCG company, like for example if you see a Reliance. Now if Reliance telecommunication plans to open a automobile industry in future, then that automobile industry, that Reliance automobile industry would be a dormant company because the plans are there but still now it is not started. So this is under the section 455 under the Companies Act 2013. Another term we have, that is a inactive company. Now, inactive company is one which has not been carrying on any business operations or has not made any significant account transaction or has not filed financial statements and annual return for the last 2 financial years. Means the company is not doing any kind of business for the last 2 financial years, and so hence there is no accounting transactions, and hence it is more or less like a sick company. I hope you are understanding. There is no confusion. So if you have any confusion, you can send me, ask your queries to me, and I would be ready to answer you. Okay, then let's go to women director. Now the Companies Act 1956 didn't have any compulsion on having at least one women director in the company, but the Companies Act 2013 has made it mandatory for the company to appoint at least one women director. So any listed company, each and every listed company shall appoint at least one women director. So this is the rule which has been made by the Companies Act 2013. Even there is certain rule for every public company also. Every other public company having paid up share capital of rupees 100 crores or more, or turnover of rupees 300 crore or more as on the last date of latest audited financial statement shall also appoint at least one women director. Meaning is any public company. Now you must be knowing what a public company is all about, where people can become the shareholders or they can have a stake in the company, and whose paid up capital, share capital means the company's worth is 100 crores, and also it is having a profit of turnover of rupees 300 crore. Means a company at the end of the financial year, the total amount of money which the company is having is 300 crore or more. So this kind of company has to have one women director. Now, you must be knowing what is the meaning of an auditor. An auditor is a very important part of a company. Auditors are the people who gives you the actual picture of what a company is, right from what kind of business it is having, right from whether it is going on profit or a loss. They keep track of each and every transaction which is going on in the company. So the auditors is very important part. But in Companies Act 1956, there was no rotation of the auditors. So regarding that also, Companies Act 2013 has given certain kind of ideas. So they have said that there is a mandatory rotation of auditors for the listed and other specific class of companies. So any companies who are listed, so there should be a mandatory rotation of auditors. One auditor cannot be there for the entire financial year. It has to rotate. We have individual auditor and we have audit firm auditors also. In individual auditors, the auditor has to rotate after a term of 5 consecutive years. Means a single auditor can be an auditor for 5 years. After that, the auditor cannot be an auditor for that particular company. It has to rotate. It has to go to another company. The audit firm to be rotated after 2 terms of 5 consecutive years. Now, if you're taking help of an audit firm, then that audit firm can do the auditing for that particular company for 2 terms of 5 consecutive years. Means twice they can go for a auditorship. After that, it has to rotate. Okay friends, now let's go to the next one. There is another term which has been described. It is the whistleblower mechanism. It is simple, like where the employees or directors, anyone facing any kind of problem regarding the unethical behavior, then suspected fraud or anything, or there is a violation of code, conduct or policy, anything not taken care of properly, it is against the company's rule, they can go and complain or report to the manager concerned. Then we have a term known as the secretarial audit. So secretarial audit is a process to check compliances made by the company under corporate law and other laws, rules, regulations, procedure, etc. It is a mechanism to monitor compliance with the requirements of stated laws and process. So basically, what the company is doing, is the company following the company rules? Is it abiding by the other laws and regulations of the country? Is the company actually a legal thing, right? Whether it is following everything regarding right from the promotion, right from the appointment, salary, then auditing, everything. So all these things, whether the right procedure has been followed, this thing can be done by the secretarial audit. So it is basically a monitoring phase to check whether the company of the country is following the proper rules and regulation. Then we have a fast track merger. The Act simplified procedure for merger and amalgamation of certain class of companies such as holding and subsidiary and small companies. Now friends, you must be knowing what's the meaning of a merger and an acquisition. Merger means when two companies come together. For example, Allianz and Bajaj, these are the two companies which are merged together to become a single company. Previously, the procedure
पता नहीं रे बेटा, देख तो मेरी फोटो तो दिख रही है।